I'm about to show you the exact four-fund portfolio that has returned roughly 13% a year over the past decade, with zero stock picking, zero day trading, and no complicated strategy required. While everyone else panics during market drops and chases whatever is trending on social media, this portfolio has quietly beaten most professional money managers. And the fourth fund, the one most people completely mess up, I'm going to show you exactly how to pick yours based on your age and what you actually care about. Stay with me. I'm going to be straight with you. I've been managing my own portfolio for over 18 years and I have made every mistake possible. Individual stocks, I've lost money. Day trading, lost more. Late night crypto moves, I don't even want to talk about it. The turning point for me came when I realized something incredibly simple. Complexity is where returns go to die. So today I'm sharing the exact four-fund structure I'm running into 2026. This is not theory. This is real money in real funds. And by the end of this video, you'll have a clean copy and paste framework that requires maybe 10 minutes of attention per year. Before we get into the funds, we need to understand why most investors underperform. Studies from firms like Vanguard show the average investor loses about 1.7 to 3% per year, not because of bad investments, but because of bad decisions. People panic sell, they chase hype, jump in and out of stocks, and own way too many overlapping funds. Here's the counterintuitive truth. The simpler your portfolio is, the more likely you are to get rich. Four funds is the sweet spot, a foundation that captures the U.S. market, a growth accelerator tilted toward the companies shaping the future, an income machine that builds a dividend snowball, and a personal wildcard that makes this strategy yours. And if you simply set this up and walked away for 10 years, you would likely beat many advisors who charge you 1% a year just to move your money around. Drop a comment and tell me your biggest investing frustration right now. Is it what to buy, when to sell, or just information overload? Now let's break down the actual portfolio. Fund number one is your foundation, and it's so boring that it actually works. My main holding here is VOO, the Vanguard S&P 500 ETF. This is my anchor. It holds the 500 largest companies in the United States. Apple, Microsoft, Nvidia, Amazon, Google. They're all inside this one fund. If you only choose one fund from this entire video, it could honestly be this one. To be totally transparent, I also own VTI, the total US stock market ETF, but only because I started a personal habit back in January 1st, 2024, where I invest $5 a day into it. That's not a separate strategy. It's a disciplined experiment, and it's been insanely powerful for consistency. Here's the key thing for you to know. You do not need to own both VOO and VTI. They are extremely similar. VTI just includes smaller companies and is slightly more volatile. Over time, their performance is nearly the same. So for simplicity, just pick one broad-based ETF for this section and move on. Other excellent choices for broad-based US stock market ETFs are the SPY, IVV, SPLG, FXAIX if you're at Fidelity, or SWPPX if you're at Schwab. They all serve the same purpose, broad US stock market exposure. This is your sleep well at night money. In 2022, it dropped about 18%. Then in 2023 and 2024, it came roaring back. That's how long-term investing works. This is your foundation. You set it and you let it work. Now let's move to fund number two, the Growth Accelerator. This is where we tilt the portfolio toward the highest growth companies in the world. My personal choice here is QQQM, but there are many great options in this section. It makes up about 15 to 20% of my portfolio. QQQM tracks the NASDAQ 100, the top technology and innovation-driven companies on Earth. Nvidia, Apple, Microsoft, Amazon, Meta, Tesla, AMD, the leaders in AI, chips, cloud computing, and the digital economy. People ask, isn't this overlapping with VOO? Yes, and that's exactly why it works. This is intentional overlap. VOO gives you a base. QQQM gives you more of the companies that are actually reshaping the world. Instead of guessing which one will win, you're increasing your exposure to all of them as a group. That's not risky, that's strategic. If you're under 40, you can comfortably go 25% here. If you're over 55, you might keep it closer to 10 to 15%, but this section is historically what pushes this portfolio above average returns. If QQQM isn't available or you just want to see other options, here are excellent growth-focused alternatives. These are all battle-tested, low-cost funds that have proven themselves over decades. Pick whichever one matches your brokerage and your preference, then stick with it. Consistency beats switching every time. Now let's talk about fund number three, the Income Machine. This is the piece that eventually turns your portfolio into a paycheck. My choice is SCHD, and I currently keep this around 15 to 20%. SCHD focuses on high-quality companies with strong cash flow and a history of paying and growing dividends. It currently yields around 3.5 to 3.7% and has delivered excellent long-term performance with less volatility. But here's the part most people get backwards, and this is critical. Age matters a lot. When you're in your 20s and 30s, your most powerful asset is not dividends, it's time. You're still working, you still likely have a job, maybe a side hustle, maybe multiple income streams. You don't actually need your portfolio to pay you yet. What you need is growth. Growth compounds harder over long periods of time, and over decades, it will far outpace a high-yield, low-growth strategy. That's why young investors should focus mostly on growth. Now, that doesn't mean you shouldn't own dividends at all. In fact, starting a small dividend position early is smart because that snowball has more time to grow. But for most people in their 20s and 30s, dividends should not be the main focus. They should be a smaller slice. Here's a simple breakdown. In your 20s and 30s, dividend ETFs usually should only make up about 10 to 15%. Growth comes first. In your 40s, it can rise to 20 to 25%. You're balancing growth and future income. In your 50s and beyond, it might be 30 to 40% or more of your portfolio, depending on what kind of income you want in retirement. Over time, this dividend sleeve can grow into thousands of dollars per month, and that's how your investments eventually replace your paycheck. If SCHD isn't available at your brokerage or you just want alternatives, here are other excellent dividend growth options. All of them focus on quality companies with reliable growing dividends. And now we get to the most personal part of the strategy, fund number 4, the personalized sleeve, your wildcard. This should only be about 10%, but it's the most personal part of the entire strategy. This is the part that lets you customize your portfolio based on what you care about. Here are your main options depending on your goals. If you want real estate exposure without buying physical property, look at VNQ or SCHH. These are real estate ETFs that own office buildings, apartments, retail centers, and industrial properties for you, and they pay dividends from the rent collected. If you want high monthly income right now, consider JEPI, JEPQ, SPYI, or QQQI. These are income-focused ETFs that use a covered call strategy to generate consistent monthly payouts that are typically higher than traditional dividend funds. If you believe in Bitcoin long-term but don't want to deal with wallets or private keys, IBIT or FBTC are Bitcoin ETFs that let you gain exposure inside a regular brokerage account. If you have one or two companies you truly believe in, this is where you can place those individual stocks. It lets you act on conviction without risking your main portfolio. Do your research here and pick some high conviction individual stocks. Gold is another wildcard option becoming increasingly popular. Gold acts as a hedge during market volatility, inflation spikes, or geopolitical uncertainty. You don't need much. Even a 5% position can smooth out rocky periods. If you want exposure beyond US borders, consider international stocks. VX U.S. or IX U.S. gives you access to hundreds of companies across Europe, Asia, and emerging markets. And if you want almost zero volatility, use SGov. This is a short-term U.S. Treasury ETF that behaves a lot like high-yield savings account, paying you interest while keeping your money very stable. The golden rule is simple. Never let this sleeve exceed 15% of your portfolio. That keeps the overall strategy balanced and easy to sleep with at night. Now that you understand what each fund does, let's turn this into an actual usable plan based on your age. In your 20s and 30s, you're aggressive, heavy growth, light dividends with wildcards like Bitcoin or individual stocks. 30s through 50s, you're balancing, still capturing upside, but building that dividend engine. 50s to 60s, you're preparing for retirement. More dividends, less growth, and your wildcards shift from speculation to stability. Think real estate, gold, or income funds. In retirement, it's all about income. Your portfolio generates serious cash flow from dividends and covered call strategies to support your lifestyle. The percentages are ranges, not rules. Pick which fits your situation, but the structure stays the same. 4 funds that evolve with you from growth to income. Now, here's why 2026 is such an incredible moment to build this. AI investment is just getting started. Growth stocks still have a massive runway. Dividend stocks are trading at a relative discount. Valuations across the market are becoming more reasonable than they were at peak levels. In other words, every piece of this portfolio is either fairly valued or undervalued right now. If you want to see more details on how my daily $5 investment into VTI is going, check out this video right here. Take care, and I will see you in the next one.